The AI investment wave is spreading its gains well beyond the companies most investors expected to benefit first. When artificial intelligence spending started reshaping markets in 2023, the early winners were obvious: semiconductor companies, the firms that design and manufacture the advanced chips used to train and run AI models. Those stocks moved fast and hard. But that was just the opening chapter. What the market is now making clear is that the list of beneficiaries is much longer than a handful of chipmakers. Technology companies tied to AI infrastructure, software, and data services have drawn heavy institutional buying over the past 2 years. For some of those firms, the result has been share price gains of several 100%, far outpacing the broader market, and the moves have come relatively quickly. That pattern matters for anyone trying to understand where AI money is actually flowing. The logic behind it is straightforward. In the early stages of a major technology build-out, the companies selling the core hardware tend to win first. Think of it like a construction boom. The companies selling steel and concrete move early. But as the build-out matures and spending spreads through the economy, companies further along the supply chain start to see their valuations re-rated sharply higher. Software platforms, data services, cloud infrastructure, each layer of the AI stack is getting a second look from institutional investors. That does not mean the gains come without risk. When a stock rises dramatically in a short period of time, it typically means the market has already priced in a great deal of future growth. There is less room for error. Any signal that AI spending is slowing, or that a particular company's competitive edge is narrowing, can reverse those gains quickly. High expectations cut both ways. For the broader market, the persistence of AI enthusiasm has provided meaningful support. Major indexes have held up better than some analysts expected, given that interest rates remain elevated and economic growth is uncertain. AI-driven buying has been part of the reason. But that support is not unconditional. It depends on whether the major technology companies, the ones writing the biggest checks for AI infrastructure, keep accelerating their spending. That question will not be answered in the abstract. It will be answered quarter by quarter in earnings calls and capital expenditure disclosures. The next round of major tech earnings reports will be one of the most closely watched tests of how durable this investment cycle really is. The practical takeaway: watch capital expenditure guidance from the largest technology spenders. When those numbers move, the rest of the AI trade tends to follow. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.